Welcome to Stock Market Trading Retire into the Stock Market. We're with Michelle, session 9. We're talking about the market dipping. Like if we have a 10% dip, let's say we have an account of 4,000 and we have a 10% dip, that's 3,600. So you have to accept that your whole account could go down, 10%. 20% would be a 4,000 account going down to 3,200. And a 30% dip, which is not that uncommon, means we're going to be down 1,200, which is 2,800. Is that right? So that's like a large dip. So like you have to understand that that's going to happen in cycles. So we just have to tolerate it. And there's a couple things we can do, but the first thing we can do is consider buying on the dip. So you buy, so just put down buy when market is down. So like this is something that is a general rule. Like you have to understand that a lot of investors, or especially new traders, new investors, they'll have their account go down 25%. They'll get terrified and they'll sell. And they'll be like, "Oh my God, I lost so much money,"
Yes, that's what happened. That's what happened to me because I had some more Hershey, and it was going up, and then it was going down. I just said, let me just keep one. So I said, Lord, and then afterwards I said, should I just left it because it started going back up again.
Right. So you have a cycle, right? So the first rule is like never to get scared out of the market. I put here, don't get pushed out of the market by the big boys. Don't get pushed or scared out of the market. Market by the big boys. Because there's always going to be manipulation, people selling, drop the market, and then while everybody else, some people are selling and losing money, they're looking to buy at a low price. Like Warren Buffett, when the market crashes, you'll see him there with a shopping cart. He'll be on the TV. They'll have Warren Buffett there with a shopping cart buying stocks, right? So what's happening? He with other large investors are selling when they have a nice profit, when the market's up, then it comes down, then they're buying, it goes up, then they're selling. And meanwhile, small people that don't know better, they're going to this roller coaster ride, and they're going, it's down, pull my hair out, what do I do? Do I sell? Do I buy? And it goes up, and then they go, oh, should I buy? Look, at everything's up, I'm doing great. 1 month later, oh, it's going down. So it's we have to tolerate the cycle. And if we're long-term investors, we're going to make an effort to buy when it dips. Buy the dip. So I always say to have cash, which is like 10% cash. So like if you have let's say you have 5,000, right? Just round up to 5,000. It's good to have like 10% cash. So you spend 4,500 in stocks. Then you have 500 cash. That way, when the market dips, you'll spend the 500 cash, you'll buy more stocks. So you don't always have to have 100% capacity in your account. You can put 90%. So you have 5,000, 90%. In this case, in this simple portfolio, you have 90% stocks. And you said you had Netflix, Apple, Starbucks, and then you have 10% cash. So that's $500, right? And then your stocks is 4,500, right? In this case. So when the market dips, it corrects, and your stocks come down. The ones that you like, so you've been waiting for this. This takes 6 months. It might be 6 months, a year. It might be 18 months. So what happens is you get a chance to buy your stocks at a discount. So these stocks you like so much, the ones that we talked about, we have standards, we have stocks that pay dividends, we have stocks that do well with covered calls, we have PE, we have earnings, which means they make money, they don't lose money. We have a 10-year chart that goes up. At least it maintains. It doesn't go down over 10 years.
Yeah, and that's one of the things I was trying to look at when I was looking at stocks that have that pay dividends, because that always works out well.
Did you get your Philip Morris dividend?
Yes, I believe so.
Okay, yeah, just look in your account. It will drop in your account. And you can set your account for reinvesting the dividends, or you can set your account for cash dividend. If you have a cash dividend, you'll receive like, I don't know, you have 2 shares, 3 shares of Philip Morris. You're gonna get like $5 a year or something. So you'll get like $1.80, every quarter. So you'll see that drop into your account. But if you reinvest the dividends, you're going to have more shares, and you don't have to pay commission on those. They're free shares. So you'll have, if it's 3 shares, you'll have 3.001 or 3.02. And eventually you'll get to where the dividends will give you another share. So you'll have 4 shares over time, not right away. But the point is, if you reinvest the dividends, you're going to have more shares to get more dividends.
How do you reinvest the dividend?
You just have to set your account to reinvest the dividend. There's only 2 things you can do. There's reinvesting and there's cash dividends. So you have to call your broker. I mean, you can look on your account. If it says 3.005, that means you're reinvesting dividends. But if you see a ledger in your account and it says cash div or div, it'll say like $1.80 or $2, then that means that you're getting cash for your dividends. So what you have to do, if you want to like what I do, one of my accounts, I take the girls to buy ice cream. We get our dividends, because that's just showing you, look, we're using your fruits. We're receiving our dividends. Like, we have money. We're gonna go buy something, But my other accounts, other long-term accounts like my IRA, I have them set to reinvest the dividends. So I'm getting more shares. So you can look at your history, pull up your account, look at the history, and look at the ledger, and it'll show every quarter for Philip Morris. It'll show every 3 months. It'll show your
Where
dividend.
do you find the history? Where's the history?
So you go under accounts. You go under account.
Yeah,
and then there's like a balance tab, and then there's a history.
History and statements.
Yeah, and you have to do 3 months, because you have to show when the dividend is, and every 3 months you'll get the dividend, and
so when I go
to track it down.
So do I go into transactions or statements?
Statements.
Okay.
And you're looking for, put it on like, can you put 90 days? And then you're gonna look at, it'll say PM, and it'll show the dividend.
Okay.
And if you're not getting shares, and you want to get shares, you don't need the cash, then call TD, call your broker, and tell them you want to reinvest the dividend. They just push a button, and then you just automatically reinvest it, so you get more shares. And to put it like an example of math, if you have 100 shares, let's put it this way: you have $100 invested, and you're getting 6% dividend, okay, which is about what Philip Morris pays. Then you're getting $6 a year in dividend. And you divide that by 4, it's like $150 a quarter. So it's not a lot of money, but the dividend, is kind of like free money. It's income. What people do, what dividend investors do, they get $1 million in dividends. And if they're making 6%, which they do at Philip Morris, then they're getting $60,000 a year, and you can live off that. So that's something, you know. It's like an income. If you put that with your Social Security or with your pension, then you can have a good living. You know, even if it's 60,000, you can still live off that. You just have to, control your expenses. Don't go too many parties. You know, too much lavish spending. You know, dividends are taxable, but it's just like when you have a job, you make money, you have to pay taxes. The same idea. So at $100, you're getting $1.50 a quarter, which is every 3 months, and you're getting $6 a year. But let's do this. Let's do $1,000. Okay, then you're getting $60 a year. You're getting $11.50 a quarter. Okay, and if you got $10,000, you're getting $600 a year. You're getting $115 a quarter, which is when they pay the dividend. $100,000, giving you $6,000 a year. $1,150 a quarter, and then 1 million. Like I said, you know, at $1 million, you might want to put in a couple different stocks. Maybe not all one stock, but like Philip Morris, Coca-Cola, these stocks are pretty steady. So honestly, you don't really have to diversify. And I say that, people think I'm crazy, but you got to understand that diversification is mostly to protect yourself, you know, like to protect yourself from losses. But if you spend time making your core 10 stocks, you're studying these stocks, you're looking at the companies, you're being very selective, we have standards. You don't have to diversify too much because you want to get the benefit of these stocks when they move, and you want to get the full dividend, you know, which in this case, at $1 million is $60,000 a year and $11,115 per quarter. That does it.
I should have gotten my husband to come in and sit here with me on this lesson because he has a lot of different stocks, right? And what I remember, he was showing them to me some time ago. He has 3,700 shares in one stock. He's got 600 in another. He's got a lot of stock. And I'm telling him, hello?
I'm here with you. Go ahead.
Okay. And I'm telling him, but you need to really look at what you have and how the PE is, because I was talking to him about the PE and everything, that you can't be buying stock when the volume is so low that you don't even have they don't even have they're not even making any revenue. So
right. So here's the thing. It's hard for me to teach people that have been doing something for so many years, you know?
Yeah.
I'll tell you, with when you take my class, you're getting 30 years experience in like 3 years. And I say 3 years because it only takes 3 months to do my course, but you're going to get the experience to apply these trades, to learn how to select stocks, to invest. And it's going to probably take you 3 years before you start getting good at it.
Right.
And I'm telling you, I did this for 30 years, and I'm teaching you how to do it in 3 because you have to also have the experience. I can't just tell you this is exactly what you do.
Right. But he was asking me, so what did your teacher say about this? What did your teacher say about that? I said, he knows what he's doing, right?
We don't. I teach you not to buy, weak stocks, small companies, because most of them don't make money.
No, and that's
I
what
teach you to buy the big, high-priced stocks. See, this is the thing. There's like this mental belief that you're not supposed to buy stocks that are expensive. But if you're going to buy a house, you have to buy the quality You want to buy quality. If you go shopping, you want to buy quality. So it's going to cost more, you know. So the stock market is not a bargain, you know, shopping center. You know, you want to buy, you don't want to buy garbage, you know. So I always teach to only buy stocks that make money, that do well, that have good charts, that have good PE. Dividends are great, you know, volume, a lot of volume. Volume should be, you know, 1 to 2 million a day. If it's not that, then you have to think about, well, what's the stock good for? You know, is it making good money? Do they have a lot of employees? Do they have a good product that serves the world? Most people, they kind of gamble on the stock market because they don't know, first of all, they don't know how to pick a good stock, but also they're buying stocks that really are not, don't make much money at all and don't return money, don't return profits for the investors.
Right.
So if we go on something like Apple or Netflix or Starbucks, Nike, for example, we're getting stocks that have a tremendous exponential return over the years. And we think they're going to keep doing that. And so we don't mess with those small companies that don't really make money, don't do anything. But it's hard for me to tell someone, hey, you know, your stocks are crap, because they love those stocks. They're doing this like as a hobby, but also like for a lifetime. So, you know, I can't tell them, you know, because they'll get mad at me. They'll say, well, you know, they're not going to like me, you know. But there's deliberate reasons for doing what I do. So I'll just say, listen, this is how I do it, and you can try it. You know, you can keep your stocks on that side, and then you can try some new stocks and see which ones do better.
Well, you know, he is going to retire the end of next month, and I think that he should take your class. I really think so.
I'll teach him, you know, and I think, you know what, if he's going to retire, he might like to do cover calls, because that's the income stream. So I can teach him that, you know, and since he's retiring, you know, we can do some very safe trades, not risky trades. So you're not gonna, you know, you're not gonna risk your whole account. You know, you're just doing, you know, quiet, safe, small investments. You're not putting a lot of money at risk. We're not doing crazy risky trades. So he might like that. I misspoke on the Philomores. You're getting, this is what it is. You're getting $1.50 a quarter at $100, which is $6 a year. Okay, you're getting $15 at $1,000 investment every quarter. With a $10,000 investment, you're getting $150, and with $100,000 investment, you're getting $1,500. And with $1 million investment, you're getting $15,000 a month, every quarter, and that makes $60,000 for the year. So that's what I was trying to say. I messed up. You didn't catch me on that. I caught myself on that.
No, I didn't.
So dividends are good, because even if the stocks are coming down, you're going to get that dividend. It just comes in your account, and you don't really notice. Did you find your dividend in your history?
Okay, I looked it in the history. Okay, January. I don't see no dividends.
I have to look when that one pays. I wrote it down, but it would be, I think they actually pay in February.
Okay, this one here says dividend.
We can always call our broker, and they'll go over it with us, and they'll tell us when the dividend pays, and we'll look in the account. And if you don't need the cash, just put your dividends to reinvest. You have to call them. Even if you have to wait 45 minutes, it's worth calling them, because then you don't have to, you get your account set up. You don't have to call them again until you need something else. And your dividends will going to be, and also, you know, Coke pays dividends, Nike pays dividends, Apple pays dividends. So you probably want to get your account to reinvest the dividends. And it's just tell your broker and he'll just put a dot, and it'll start doing that from now on. It won't change until you change it.
Okay.
So look into that in between sessions, and let me know if you can get it. If you need help, I'll call you between sessions and I'll walk you through it again.
Okay, I would like that. Call.
Okay, so you got a question?
I'm trying to write down what I just said. Okay.
I want you to write out your stocks and then put a percentage of dividend. There's a yield, and that's the return per year. If you look on your stocks app, it'll have the yield at the bottom of each stock. And you can see it on your account if you want to. You have your account open. Go to go to history and research. Do you see history and research under? And then you're gonna go into, you just put the stock in. It'll show you a screen. You just put the stock in, and then you can look up. It'll show you the volume. It'll show you the PE, the high and low for the day. It'll show you the price. In this case, we can look at whatever, Philip Morris or Starbucks. It's under research.
Research.
Do you see it?
Research, and what am I looking for?
Click the research, and then it'll show your screen, and you put in the stock symbol on the right side.
Stock. Okay, going to research and ideas and check what? Stock profile?
Yes. And then on the right side, you'll see a window, and you can put in the stock symbol. Can you do that? And they'll have a stock there for you. They'll have the last stock that you were on.
And nothing come up.
Did you click it?
Okay. Philip Morris.
Okay, so Philip Morris is there, right? Can you see? It says volume.
I don't think I'm in the right thing because
it should show PM symbol. And a lot of numbers.
Let me go back. Not coming out.
Research and ideas, and then click on.
Okay, and then Philip Morris that comes up with the stock profile.
Yeah, you see like price, symbol, PM, price, 86.50.
Yeah,
see that?
86. Yeah.
Do you see? Read me what you see.
It says it just says stock profile, and then it says Philip Morris International. You come down and you see the buy and sell, and it says 86.50. The day's change went up $1.05. And then it has the PE and all of that stuff.
What's the PE?
The PE is 16.57.
That's a good PE. Now, do you see where it says yield or dividend on the right side, right column?
It says X dividend date was 12/22/20.
Okay, stop right there.
Date. Okay.
Dividend date January what?
January dividend pay date January 11th.
January 11th. Okay, so January 11th you got the dividend. That means February, March, and April. So not until April will you get another dividend. Probably April 11th. Which by the way is my birthday, April 11th. So you know.
April 11th, yeah.
So you get the dividend again on April 11th. You got it on January. So look on your account. Not right now. but in January 11th, and you should have the dividend. It's probably, it'll tell you how much it pays. You see the dividend, it'll say like $1 something, $1.50. Where does it say? Right
Where?
there.
On the same page?
By dividend, right next to dividend. I'm looking for a percentage yield. I'm looking for the amount. I'm looking for the yearly yield, dividend, and the amount. Same on the right column, same place you were reading.
No, wait. Okay. Wait.
By the dividend, it has yield, it has the amount, it has the amount per year.
No, I'm not seeing that.
Well, you show me the dividend date, right?
Yeah, but
right above there, it'll tell you the amount.
Is this what the screen is supposed to look like?
Yeah, on the left, right in the middle row. It'll tell me about the dividend. Can you zoom in?
But I don't see anything about. Oh, see the dividend. Oh, it's $4.80.
Okay, $4.80.
That's not bad at all.
For the year. Okay, so you get $4.80 for the year. So that means you get $4.80 per year per share. Per share. So then it would be $1.20 per quarter, right? It should say 120 and then 480. So you do have it. So I want you to write down the dividend for all your stocks. Okay.
Okay.
That's gonna get your mind thinking about these just income you're getting. Since you have a smaller account right now, you're not really gonna tell so much now, but think about, when your account gets bigger, you're gonna be ready for these dividends. You're gonna be ready to get this money. You can track it, and when the stock dips, when the market dips, you're gonna be ready to buy because you've planned for this. This is the goal. We know we're gonna have cycles. We're not gonna be scared out of the market just because it dips. We're gonna think about buying these great stocks, which we planned, which we've looked for, we've searched for. We found these great stocks, and we're going to buy them cheaper. And we're gonna stay with the market. We're not gonna get scared and run away. So we're gonna put the yield on a piece of paper, write it by hand for all our stocks. And like Netflix doesn't have a dividend yield. I'll say that right now. But Apple has one, Starbucks, McDonald's, Philip Morris, Nike, Hirsch, all the rest of them have dividends. They're small. The dividends are usually small. Like I know for a fact that Apple and Starbucks and Nike have very, very small dividends. It's not a lot of money. It's not like Philip Morris, but they're not dividend stocks per se. So they just say they pay 1% a year. It's not a lot, but it's something. So it's better than nothing. And then the Philip Morris pays a lot. It pays like 6%. So don't expect the Philip Morris stock to go up a lot, but the dividend is going to count because it's higher. But we can expect Netflix, Apple, Starbucks, McDonald's not so much, Philip Morris not so much, Nike, I would say Hershey, Coke not so much. These stocks, Nike, Hershey, Starbucks, Apple, Netflix, to have a great long-term returns on the share price. So like, for example, if Netflix is 500 now, maybe next year it'll be 600, like that. And Apple is 126 now, and it might be 150 or 175 by next year. We're looking longer term. And I'm just forecasting it, it could be down, it depends on what happens. But if you're getting good stocks that are doing great, then we're going to plan on them continuing doing great.
Yeah.
Any questions on that? So do research on all your stocks. Start putting down these numbers, and just ask me if you have any questions on what's important, what you look for, and I'll help you navigate and help you find your dividends. And call your broker and ask TD to set your account up to reinvest the the dividends. That'll get you more shares. So you start having like 6.01, 0.02, like that. And then after a while, you'll see.
I got a whole new stock. A whole new share, right?
Yeah, eventually you'll have a whole new share. And if you have a lot of shares, like if you have, let's say $1 million, right? And you didn't need the cash, you just wanted to reinvest in shares, you're going to get 60,000 in shares a year. And that means that at $86, do you have a calculator?
No.
I'm going to do it for you.
No.
Say I had $1 million, getting 60,000 a year. Divide that by the Philip Morris price of $86.50. You're going to get actually 693 shares per year dividend. So the first year, after the first year, you'll have 60. Wait, let me see how many shares we got. We have $1 million divided by 86.50. So we have 11,560 shares. But then after 1 year, we're going to get 693 more shares. Plus 693. So then we end up getting 12,253 shares by year 2. At the end of year 2, we're going to get another times 1.06. We're going to have 12,988 shares, almost 13,000 shares. Because we're not getting cash, we're reinvesting the dividends, so we're getting more shares. So that actually gives us like an exponential return. So that's good. Make sense?
Yep.
So you're gonna be calling your broker, right? So what other questions do you have? We're talking about buying the stock when it dips. We're talking about don't get scared away. We know our stocks are good, so we know that we're longer. In this case, we're a longer term investor. We're not like a day trader, so we're holding on long term, and we're buying them cheaper, right? We're looking at the dividends, right? We understand how much dividends we're getting. Like if we're getting 6%, that's 60,000 a year per million. If we're getting 1%, that's $10,000 per million. What's 1% of 100,000?
10,000.
1% of 100. 10,000 is 10%. What's 1% of 100,000?
1,000.
Right. So if you have 100,000, you get 1% dividend, which I think like a few of these stocks pay 1%. Not much. You're gonna get $1,000, value per year. So that's, well, it's not a lot. It's something. And if the market goes down, you're seeing this income come in your account, and that's the value. Whether you don't have to worry about, like with dividends, you don't have to worry about trading. You don't have to worry about timing the market. You don't have to worry about ups and downs. What dividend investors do, they just try to buy more, when it dips. If they have pension, they just take their pension and buy more shares because, it just makes them more money exponentially. And if some of these stocks, if some of these stocks give you share growth, which means they go up also, then you get a dividend plus share growth, which is great. So here, write this down. You have share growth. I'm gonna give you the layman definition. Stock moves up. The value. Share growth is the value of your stock price moving up. So if you have a stock if Philip Morris is 86.50, then it goes to 100. It won't go there right away. It takes some time. Okay, so it goes to 100. Then you've gotten 1350 points on share growth, right? Now we know that we're getting you told me 480 dividend per year. So we're getting 4.80 points on dividend. So it's like saying, am I putting you to sleep?
No, I told you when we started I was tired.
It's like saying if you have an $86 stock, $86.50, and you're getting 480 in you told me it's 480 in dividend. You told me that. So what it's like saying, take the stock, after 1 year, you're going to get 480 points. So you're going to have 86.50 plus 480. So you're going to have 90.30. So you're going to have basically 90, like a stock that's $90.30 because of the dividend. If the price maintains, the price can go down, you know, then you have whatever you have. But the dividend is like icing on the cake. It's just extra money. You know?
Right.
So put here, dividend, extra money, income, icing on the cake. And I'm also going to say share price should maintain. So don't get a stock if 1 month the share price is 80, the next month it's 70, then 60, and by next year it's going to be 50 or 40. So now we're losing money on the share price. So it doesn't really matter the dividend. So don't get a stock that doesn't maintain share price. You have to have the share price. If you look at Philip Morris over the last 10 years, it's maintained the share price. It at least has not lost money. I think 10 years ago, I remember it to be about $70, $60. And it went up to like 90, 95, then it came back down to like 60, and now it's back up to 80. So like I said, cycles, if you paid attention and looked at these cycles going up and down, you can actually buy them when it dips or buy more. And then when it goes back up, then you'll see you have a nice return. And from what you were telling me, you don't really want to trade right now. You want to build your account. So you're just buying stocks when they dip, the good ones, and you're seeing your account grow as the stocks go up, the stocks go back up. Did you want to do some trading or no?
Sure.
Because okay, so let me just touch on trading and then we're going to wrap up because I don't want to put you to sleep. Okay, so let's just do trading for a second, okay? Trading, write this down. As a trader, traders make money by buying low and selling high. Okay, but just buy low, sell high. There's a lot of different ways to trade, but I'm going to keep it simple for you, okay? So like, you know how you said stocks came down today, right? And you were saying Apple and Starbucks and Philip Morris and Nike did very well. They're up in your account, right? So let's say Starbucks, for example, is 101, okay? When you look at the 6-month chart, 6-month chart. Now, if you look at the 6-month chart, what we'll see on Starbucks is that we'll see like a cycle goes up and down. So let's say it goes from 85 to 105. What that means is it's on a cycle up and down. So if it goes from 85 to 105, we can expect it to go down again. Maybe not to 85. Maybe it'll go down to, let's say, 90. Okay. This is just an example. It's a very simple example of trading. Okay, so Starbucks goes to 90 and then put buy. Put buy Starbucks at 90. Okay. Now, we might want to buy it at 95 because it could be on a trend going up. So let's say we buy between 90 and 95. Let's put a circle. Buy Starbucks between 90 and 95 now. Go ahead. Go ahead.
Okay, go ahead.
So we're waiting for it to drop. That's the whole point. Okay.
Right.
We're not just going to buy it anytime we have money. We're not like a kid in the candy store. Just buy this, buy that, buy this, buy that. We're not doing that. We're looking for it to dip, and then we're going to buy. And then what we do, it goes back up to like Starbucks here. 101 is 101 today.
Yeah. It was 107 the other day.
Yeah. So let's say between 100 and 105, we sell. What am I doing? I'm giving you like a basic strategy on Starbucks to trade. Okay. Now for you have a small account. So maybe you just do it. You have 7 shares here. Maybe just do it with 2 shares just to understand how this works. Okay. Buy between 90 and 95. Sell between 100 and 105. What are we doing? We're buying low and selling high. Okay. Now, even if we do 2 shares, give me a price between 90 and 95. We'll make this real go.
Okay, 92.
That's it, 92. So at 92, we buy. And then guess what? We have a lot of volume. We have a good stock. We have a decent market. Market's kind of, I don't know, you never know. But let's just say 50-50, right? But if it dips to 92, we can buy. And then we're going to sell between 100 and 105. Give me a number. It doesn't matter, the number. Between 100 and 105. It's not going to be exact, You might have to sell sooner, but any number, just pick it. 100 to 105.
Well, I want to sell at 104.
104. Okay, good. So how many points are between 92 and 104? How many points? So
12.
5. So 12. Okay, so 12, that's our profit. 12 points or $12 per share. So how many shares are we going to trade with? How many shares? Tell me. Doesn't matter. Just pick a number.
We're gonna go with 5 because I have like I think 8 Starbucks.
So we're going to trade 5 shares at $12. So 5 times 12 is $60 profit. Now, right now, there's no cost for trades for stocks. It's free, commission. So that's good for traders. It's sort of good. I mean, it's not good if they trade too much and they make mistakes. But if you have a plan, you buy at 92, sell at 104. And if you can do that at 5 shares, do you see how you're going to make $12 a share times 5 is $60 profit? Do you see that? Now, if you consider 5 shares, I'm gonna go to my calculator, so I'm gonna have to go off here for a second. Starbucks is we're just gonna do it an investment, let's say of $100. $100 per share. So it's like $500 investment, okay? And we're making $60, okay? So what we do 60 divided by 500. 12%. It's a 12% return. Michelle.
Yeah.
So write this down. If we're making, I'm sorry, that's I made a mistake. We're making. Oh, it is right. So if you do 60 divided by 500, it gives us 0.12, and that equals 12%. So what we're doing, you said you want to get 12 points. So it's like a 12% return. If we do, if we make about $60 and the average price is $100 for our investment. Because we won't buy exactly 92. I just rounded it to $100,
Yeah.
So we can buy 100, sell 110 for them, or 90 and sell at 100 or 102. So here's the thing. We looked at the 6-month chart. We saw a high and low. We saw a channel, put this channel, high and low. Now, if Starbucks is on an uptrend, it may not go down to the price you want. So if you're trying to get 12 points, maybe it's easier to get 10 points, for example. I'm just giving you an example. It might be easier to get 10 points and just sell. This is what big, money managers who have $2 billion account, they have a lot of pensions, they have mutual funds, they have manage a lot of money. What they'll do to increase their profits, they'll wait till Starbucks dips and they'll call their friends, hey, let's buy Starbucks. It went down. And then the prices start going up, people start buying, and within a few months, it does this 12-point move, the one that you planned for. And now we can sell, and they'll sell, you know, and they'll get the money out, they'll get 12% return. If they can do that, they get to keep their job, they get to get money, they get to get a bonus, they get to be a successful investor, trader, money manager. So, and that's why the markets move. So, I mean, some of the reason the market moves because you have big traders that are selling, and you have big traders that are buying. When they sell, it makes the price go down. When they're buying, it makes the price go up. Make sense? And you're going to take 5 shares and try to do a trade. You know. Now here's the thing: Starbucks may not come down right away to 92. So this is why you have a core tip. Now you have 1, 2, 3, 4, 5, 6, 7. You have 8 stocks. Excellent. Maybe Starbucks won't come down right away, but what if I told you we're going to put a buy point for Coca-Cola? If it dips, we're going to put a buy point for Hershey. If it dips, we're going to put a buy point for Nike. See, let's say Hershey goes down to, it's 148. Let's say Hershey goes down to 130. We're going to buy. If Coke is 50, say Coke goes down to 40, and we buy. Let's say McDonald's is 212. Let's say McDonald's goes down to 190, and we buy. What happens is we have 8 stocks to choose from. So believe me, one of these stocks will go down for sure. And then we're rotating. So now let's say Starbucks is the first one to go down, 92. Buy that, trade that. And then guess what? Oh, look, McDonald's dipped. Buy McDonald's. Trade that one, get 12 points from that one, or 20 points. Look, Netflix dipped. And then Netflix went up, we sell. You know, Starbucks goes up, we sell. So this is trading. If you can get, it's difficult because if you buy a stock, even if it dips, it can still go down more. But what trading is doing, it's giving you, you have to be more right than you're wrong. And if you can see a channel where it goes up and down, up and down, up and down, the theory is it'll probably continue. So if you buy a stock that's cheap, when it dips, probably it'll go up. And if that's the case, then you have a successful trade. And if it goes down, but here's the thing, when you're trading, if the stock goes down, you really have 2 choices. You can sell it, take a loss, and then wait, or you can just keep it. Okay. The problem is if you keep it, you know, it can go down more. And then you have to decide, hey, you know, I'm trading, I'm not making money, stock's going down more. At that point, just sell it. You see? There's 2 different types of investing. There's long-term investing, which is what you're doing here. IRA, long-term, buy, hold a long time. And then there's trading. For trading, you have to sell when it goes down because you don't want to lose more money. And if you lose too much money, you're not going to be able to trade.
Exactly.
So basically, when you trade, if position goes against you, you can sell. So just put sell. If position goes up to profit, sell. See, so you're selling either way. You're selling either if it goes down or if it goes up. The thing is when you're going to pick your stock, you pick it at a good price. And the theory is that if you did that right, it'll go up. You'll be right more times than you're wrong. If you can do that properly, that's successful trading. Yeah. That's all it is. You're going to have some losses in trading, so it's kind of difficult. But if you have good stocks, you know, if you take your time to select these good stocks that are making money, that are doing well over time, that have dividends, that have cover call income, you're going to notice that those stocks are going to outperform the market. They're going to do good. They're going to keep on doing well.
Okay.
And when you trade, you'll have like an advantage because you're in a good stock. You're not in some dog crap penny stock that doesn't have any profit. You know, you have a real company that has a lot of employees. They have income. They have revenue. They have a good product. I don't know, Apple, Chipotle. You know, that's a good one too. I'll write this one down. CMG. Starbucks. So think about investing in good companies, and you're trading. You have the advantage because you have a great company. So even if it goes down, you're not so much at risk. If you have like a penny stock that goes down, you're just out of luck because there's not enough investors in that stock that's going to bring it back up. But if you have, a good stock, Starbucks, Apple, Netflix, these stocks are maintaining their price very well. They're going up over time. So you have an advantage. So I'm going to put this down. You have an advantage. You have an advantage trading. I'm just going to put excellent stocks over. I'm just going to put losing stocks or average even stocks, because these average stocks or losing stocks don't really go up over time, and there's no advantage to trade them. Make sense?
Yes, makes sense.
So that's a little bit about trading. And if you look at the channels up and down, you'll see a pattern. And if you can decide to decipher the pattern, you probably do a good trade.
Okay.
That said, it's difficult to trade. It's much easier to long-term invest. It's much easier. But I'll tell you one more thing about trading. When you're trading, you have your cash in hand. If you sell, if Starbucks goes up, buy Starbucks at 92 and sell at 104. Congratulations, you made a successful trade. You made money, and guess what? You had the cash in hand. You sold it. You have money. You can buy stuff. You can put it back in the market. You can wait. You have the option. If you just hold Starbucks, you see it go up and down. It goes up to 101, goes down to 92, goes to 104. You're just not. You don't have the money. You don't have any way to spend, or you have to. If you want to access your money, you have to sell. Because you can't pay your mortgage with shares in that you're holding on to. You have to sell at some point. So traders have the advantage. Go ahead.
No, I was saying, and I bought Starbucks and it was $80-something.
Yeah, good. So traders have the advantage that they have cash in hand. But this traders have the advantage over long-term investors because they have cash in hand. And I'm going to put a last thing here. Traders will incur losses. Long-term investors don't lose until they sell. It's just like a comparison, like at least mentally, long-term investors don't feel like they're losing until they sell. They're losing the moment their stock goes down. But if you compare a trader who has losses here and there to a long-term investor, the investor doesn't care that their stock is down, you see, because they might buy more. They're going to hold it. But the trader, he's trying to make money. He's trying to get money out of the market. He's trying to pay bills, whatever. So, or she. So they have to sell it to have a loss because they can't incur a greater loss. So they'll have some losses. So there's pros and cons, Traders have the cash in hand. Investors don't have any cash. Traders will incur losses. Investors don't really have losses until they sell. At least that's what they that's the conceived notion, right? Makes sense?
Yes, it makes sense.
Okay, let's do some notes. Let's send me some notes. I will send you some notes from the last session. I
Okay,
missed on that.
and send me the notes from the last session and the video from the last session.
I'll do that.
Okay. Yeah. And I promise you I'm gonna go through all that stuff, all the stuff that that we had gone over today and our last thing. I'm gonna go over the videos and everything and all the notes and everything, and next week I'll be in good shape.
Okay, so next Monday, 2 o'clock.
Yeah. Okay.
Thank you, Michelle.
Okay then. Bye-bye.
Have a good day.